And joining me now with more is resident expert Andy Walden, Vice President of Research and Analysis at ICE. Andy, always great to see you, especially on a Monday morning. And what are the top takeaways from February's Mortgage Monitor?
Yeah, a lot of interesting insights coming through the door here at the early stages of February. The first is that mortgage delinquencies are gradually beginning to trend higher, especially on the lower end of the credit and lower end of the income spectrum. And that certainly will be an increasing focal point for the market as we move into 2025. A lot of data coming in around the recent wildfires in Los Angeles about insurability and insurance, along with some of the financial pressures that are facing homeowners in those areas. And so we can discuss those here in a little bit as well. And then the latest on the housing market. So supply, demand, and price dynamics as we enter the 2025 home buying season.
Well, of course, our hearts go out to those impacted by the wildfires last month in Southern California. As you alluded to there, what does the data show about that area?
Yeah, absolutely. And the human aspect comes first, obviously. And so, as you mentioned, our hearts go out there to everybody impacted by those fires. When we start to overlay some of the geospatial data from those fires on top of public records data and mortgage data and even municipal bond data, we see a few trends that are starting to jump out here. First of all, if we get a lay of the land in terms of the magnitude of those fires, over 17,000 single-family homes and condo units in those areas, many of which were damaged or destroyed. And so this is one of the largest wildfires, not only in the state of California, but nationwide in recent memory. When you start to look at the impact on finances among existing mortgage holders in those areas, we're already seeing nearly 5% of folks that are struggling to make that January mortgage payment. And keep in mind, those fires broke out later in the month of January, and so we could see more significant impacts as we get into February and March. When we go into the insurance side of that issue, you see that the state's FAIR Plan was the second largest insurer among those affected homes. They covered about 1 in 8 homes in affected areas. I think that could have a pivotal impact for the way that the insurance is dealt with, not only in that area, but the state of California, and could reverberate outside of that state as well in terms of pricing. And so I think that's something that the market should be aware of. And then when we look at the muni market, you had nearly $60 billion of munis at least partially exposed to those areas. And for the first time, our ICE climate team has been kind of hinting at this in the past. For the first time, you're seeing some almost immediate repricing of some of those munis that were exposed, especially in the LA City Water and LA City Power municipal bonds. And so, again, something that's going to be a bigger and bigger topic of conversation as these natural disasters become more frequent and more damaging.
I do want to talk about pricing in a moment, Andy, but if we could switch gears here, there is maybe a light at the end of the tunnel, at least at the end of this week, and that's because the Super Bowl is this weekend. Hopefully it will be a fun event. I'm sure it will be. And it's my understanding, in fact, that housing data could be a predictor. So what fun stats can you share ahead of the big game?
Yeah, certainly a little bit more lighthearted research there around the Super Bowl. And we were trying to dissect, as everybody is, to try to get a little bit of an edge on what's happening in the game this weekend. What we found when exploring the ICE Home Price Index is the team that has had the hottest housing market entering each of the last 6 Super Bowls has won the contest. So that would give the edge for those folks that believe in that type of thing. I would give the edge to the Philadelphia Eagles this weekend. They've been running at about a 6.5% home price growth versus Kansas City's 4.8% growth. For Chiefs fans that are looking for some light there, if you go back to 2010 to 2017, before the last 6 years, becomes a little bit more murky in terms of housing market predictability. So, maybe a little bit of light there for Chiefs fans, but the ICE Home Price Index says maybe Philly has an edge this weekend.
Philly has an edge, and to that end, Andy, I do want to hear more about which markets are trending in which direction when it comes to pricing and other metrics.
Yeah, when you look at it from a geographic perspective, we've been seeing this Midwest, Northeast, specifically Northeast, hot, South, Southeast, cooler trend really for the better part of 2024. And it really has to do with what's going on from an inventory perspective. The Midwest and Northeast are still dealing with very deep inventory deficits just in terms of the number of homes available for sale at any given point in time, and they've been slower to recover throughout the last calendar year. And so, you're seeing firmer prices in the Midwest, Northeastern regions of the country. 18 of the 20 fastest growing markets this year from a price perspective were in those areas of the country. I think it's reasonable to expect those areas to be firmer as we make our way through the early stages of 2025. when you look at the markets that have seen inventory levels return a little bit more quickly and are now back to or above normal levels, you look to the South and Southeast, and you're seeing softer prices in those areas of the country. Unusually, the West is a little bit of a middle ground right now, where you're seeing, not too hot, not too cool prices in that portion of the country. And again, I think it's reasonable to expect those geographic breakdowns to continue as we make our way through the early stages of this year.
So, of course, on the horizon is the spring buying season. How is that expected to trend, the housing market, into that pivotal time?
Yeah, absolutely. And let's go back to 2024, and then we'll carry that forward to 2025. If you look at what happened last year, softest home price growth that we've seen in any calendar year since 2011. And so you are seeing a little bit softer price dynamic out there. Now, demand is still relatively good. It's about equivalent to where it was this same time last year, despite interest rates being a little bit softer. But the fact that you're seeing more inventory out there in 95% of markets than we were at this time last year means that homeowners, as we enter this spring season, will have a little bit more inventory to shop amongst, and will likely be looking at a little bit softer price environment than what we were seeing at this point last year.
And so how do you expect that to change the dynamics, Andy, in terms of the overall health of housing?
Yeah, I think it's a slow move in a positive direction, right? We still, as we know, we have affordability challenges out there in the market, but demand is holding relatively stable, right? Interest rates, if you look at 30-year rate futures, they're predicted to modestly come down as we make our way through the middle stages of 2025. That should improve demand out there a little bit, running up against more supply than we've had over the last few years out there in the market, which means a little bit softer price dynamic, which is what we need for affordability to improve. And so I think, slowly but surely the market moving in a positive direction here. And when you look at the housing market from a Fed perspective, I think it's moving in the way that the Fed wants it to, right? In a positive direction overall, but a slower rate of growth, most certainly, than what we've seen over the last 4 to 5 years.
Andy Walden, Vice President of Research and Analysis at Intercontinental Exchange. Andy, thank you as always.
Thanks for having me, Kristen.